Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are revising with our chapter number 9, that is cost of debt. So this chapter primarily is going to, like the name suggests, focus on the debt sources of finance for any company. Um, Primarily they have bifurcated the sources into depending upon the different types of durability that they have. So first we'll talk about the long-term sources of finance, then we'll also discuss briefly about the short-term sources of finance, and then a little bit about SMEs like we did in the previous chapter of equity finance. So firstly, talking about the long-term finance. Now, under long-term finance, there are a whole lot of instruments that we are going to talk about. Number one over here being preference shares. So preference shares, I'm sure you all know, are shares with a fixed rate of dividend, and they have a prior claim on profits available for distribution. So they will get any, the fixed rate of dividend before the ordinary shareholders. So that is why they are called preference shareholders. All right. So if you talk about the characteristics, it's a fixed percentage of dividend on the nominal value. Then another characteristic is that dividend is only payable if there are sufficient profits. However, if they will be cumulative preference shares, then you will be adding on the dividend. If you're not paying in 1 year, then you have to pay double dividend in the next year if you do not have sufficient profits. Then another characteristic being dividend not deductible for corporate tax, so you do not get any sort of tax benefit on the dividends that you pay on preference shares. Then participating preference shares is another kind of variation when it comes to preference shares. Basically over here the shareholders have a right to receive additional dividend. So in case the company has done very well in some year, so in participating preference shares, the shareholders are going to have a, uh, you know, uh, to have a right to receive extra additional dividend. Now, what are the advantages when it comes to issuing preference shares? Number one advantage is that these preference shares carry no voting rights. So the ordinary shareholders do not actually have to dilute their control. Another advantage is that it is not secured on the assets of the company. So you you know, get to take other loan on the assets that the company has. And then another advantage over here being that your dividend does not have to be paid when the profits are poor. All right. So these are the advantages. Now, let us also talk a little bit about the disadvantages. So, when it comes to the disadvantages, number one being that the dividend is not tax deductible. And another one over here being that the company needs to pay a higher return to compensate for higher risk than debt. So, the cost of debt will be cheaper, then preference shares will be a little bit more expensive, and then your ordinary shares are the most expensive. So compensate for higher risk than debt. So these are the disadvantages. Moving ahead to another source of long-term finance as far as debt is concerned, another thing that we're going to talk about is called bonds. Bonds, nothing but these are negotiable security evidencing debt. So you all know these are long-term, instruments to borrow money. So these bonds will be secured by either a fixed charge. What do you mean by a fixed charge? Basically, this means a building or, any plant or machinery which I've kept as a collateral, which cannot be sold off until and unless I actually, pay the loan. Then the second type that we have is a floating charge. So floating charge is nothing but over here your asset keeps on changing. Let's suppose I have kept as a collateral my inventory. So I will in my regular course of business be buying and selling inventory, but in case I default, whatever inventory I have, that floating charge will become a fixed charge, and then the asset, now be careful that this is in the event of a default. That means I have not paid either the interest or the principal amount. So what will happen over here? This floating charge will get converted to a fixed charge, and then I cannot sell off my asset, whatever the inventory that I'm holding, until the debt is repaid. So this is what bonds are, and then how they are, secured by which means. Then the next thing that we're going to talk about is going to be deep discount bonds. So, like the name suggests over here, deep discount bonds are nothing but bonds which are issued at a large discount to your nominal value, and these are redeemable at the nominal value at maturity. So mainly this is useful for businesses who want to finance the projects which have weak cash flows in the initial years. Why? Because you do not have to pay the money right now. These are issued at a discount, so no interest that you have to pay on them, or very less interest rate, because these are issued at a deep discount and then eventually redeemed at maturity. Then zero coupon bonds are another thing. Zero coupon bonds over here are nothing but these are issued at a discount to nominal value. Issued at discount to nominal value. And then these pay no interest, like it is, the name itself is telling you, zero coupon, zero interest. So the return that the investors are getting is only the capital gain that they make. That means whatever I purchase, let's suppose the nominal value of a zero coupon bond was 100, and the purchase price, the price at which I bought it, was 85, and then eventually at maturity I sold it at 100. So the capital gain of 15 is what my only gain on this security is going to look like. Now, let us also talk briefly about the tax relief on debt interest. So, basically, we all know any interest that we pay on debt is deductible for tax. So, if you want to find out the after tax cost of debt, it's going to be nothing but your pre tax cost of debt multiplied by 1 minus t. So if you just do this adjustment to your pre-tax cost of debt, you will have your after-tax cost of debt. Another thing that you should know is that your pre-tax cost of debt is also called as the return required by the debt holders. And then always remember that your after-tax cost of debt is always going to be lower than your pre-tax cost of debt, because of the tax benefit that you are getting on the debt. Now let's talk about another thing. This is called as convertibles. So when it comes to loan notes, there are loan notes or preference shares. So these can be issued in the convertible form also. What will happen over here? These are, these loan notes or preference shares can be converted into a predetermined number of ordinary shares. So what will happen over here is that you are issuing loan notes or preference shares, but at the maturity, at the redemption, the shareholders are going to have an option either to get the money in exchange for the loan note or preference shares, or they can get a fixed number of ordinary shares. That means equity shares in the company. And what are the advantages of this method? Number one advantage, if we are talking from the perspective of investors, so to investors, it's going to be a low risk investment and a potential to make high returns. Why? Because even though I'm only investing in debt, for which I will be getting the, interest on loan notes, or if I have preference shares, then preference dividend, but I will still have the option of getting that converted to equity. So in a indirect manner, I'm investing in equity, and the risk over here is low, and my potential to make a return is high. Now, what is going to be the advantage to the issuer? So to the issuer, the advantage, that means the company, they have to pay a lower coupon rate than on convertible debt, sorry, than on non-convertible debt. And then another advantage when it comes to younger companies meaning the company is still relatively new. So another benefit that is there to these younger companies is that this investors may not want to risk investing in equity, so they can go for convertibles. So that way younger companies can also raise money in equity. So with this, we are done with the discussion of the convertibles. The next source of finance when it comes to long-term sources are your warrants. So what are warrants? Warrants over here are nothing but they give the investor a right but not the obligation. Right, but not the obligation to purchase shares at a future date at a fixed price. So what will happen over here, that sometimes these warrants will be attached to loan notes to make them more attractive, and they may even be separated from the underlying debt so that the holders can trade the warrants. So what will be the advantages over here? Number one advantage being you can offer lower coupon rates on if you're doing it with a loan note. So if you're getting an investor is being offered another right but not the obligation, so it's a benefit that they are getting. So to give this benefit, that the company can offer lower coupon rates, so it's a saving in the cost of the company. Then if you talk about another advantage, is that it is more useful when companies' assets are inadequate to secure the debt. And another advantage over here being that it is a way of issuing equity without the usual negative symbol associated with issuing equity. Or you can say it's an indirect way of issuing equity. All right. So this is what a warrant is going to look like. Now we're done with the long-term sources of finance. These are all of the sources. Now the next thing that we're going to do, the next kind of sources that we're going to be discussing, these are nothing but your medium-term sources of finance. So now we are talking about medium term. The number one source which we study about over here is going to be a bank loan. When you all know what bank loans are, so let's straight away get to the advantages. Number one, that there is no risk of early recall. Whatever the time period the bank has given you the loan for, there is no risk. You will have the money for the entire time period. So over here, the comparison is done with OD, which is repayable on demand. So this is an advantage over here, that the bank cannot ask you on demand to repay the money. Whatever maturity has been agreed will be taken forward. And then moving to a few disadvantages. Disadvantages over here being number one, that it is inflexible. If I want to increase the maturity, there may be a difficulty. Another disadvantage that it may require security. Security meaning I have to put in some assets as the collateral. And the third disadvantage over here being that it may require covenants, which means that the bank may put restrictions on me, that I cannot do this, I cannot do that. So that is something which is another disadvantage over here. Now moving to another source when it comes to medium term sources of finance, this is leasing. Leasing, I am sure you all know, it's when you take an asset on rent, in a way. So advantages over here are number one, that there are many willing providers, and then there are very flexible packages that they offer. Another advantage being that it matches the finance to the asset. So if I need the asset also for a medium time period, I'm taking a lease also for a medium time period. So I'm matching finance to the asset. The maturity of my my finance as well as the time period for which I want to use the asset, these are both matched. So that's a good thing. Disadvantage over here will be that it may be expensive. So this was the second medium term source of finance which we have discussed. Now we will move on to another source over here. The third source over here is sale and lease back. So what happens over here is that I have sold my asset to someone and then I lease it back from them. So I take it on rent back from them again. So what will be the advantages over here? Number one advantage being that the funds raised from the sale generate short-term cash. So I can use that cash for any requirement that I may have. Now let's talk about the disadvantages also. Disadvantages over here being that the company no longer owns the property, so they cannot benefit from the future increase in value. Cannot benefit from future increase in value. Another disadvantage over here being that the borrowing capacity gets reduced because now you're left with fewer assets, fewer assets to provide as a security for loan. And last but not the least over here being that the net effect is basically equivalent to a secured borrowing. So what you do over here is that your right of use of the asset is capitalized and the lease liability is created. So what happens over here? Your gearing gets increased. Whenever the gearing gets increased, it leads to further implications that, the borrowing capacity basically reduces. Now let's move to another source of a medium term finance, which we call as a mortgage loan. This will be the fourth source that we are discussing. This is a mortgage loan. So this is nothing but a loan which has been secured on any sort of property. Now, what will be the advantages over here? Number one being the lower rate of interest due to security. Due to the security, the mortgage, the property that you have put, they will be offering you a lower rate of interest. Another advantage being over here that the institutions, whoever you're taking the money from, or the bank, whoever is it, the person who's giving you the money, is going to be willing to lend you for a long term. And another advantage over here being that the company can still participate in growth in property value. Now, because technically I am still the owner of the property, if the value of the property goes up, then actually I am the one who gets the benefit, because ultimately when I repay the loan, the I can, sell off the asset, and then I will benefit from the price rise or the increase in value of the property which I own. Moving ahead to disadvantages now. Disadvantages over here being, number one, that there may be restrictive covenants. That means restrictions levied on me by the bank with regards to the use and disposal of the asset. Now, these restrictions will only remain until I have not paid the loan. Once I pay the loan, these restrictions will get removed. In time of default, this is another advantage. When I have defaulted, that means when I did not make a payment, the bank may force the sale of property to recover their money. So this is what we study about the medium-term sources of finance. Now we are going to move towards the short-term sources of finance. So these are short-term sources of finance. Number one that we discuss over here is going to be a bank overdraft. You all know what an overdraft is. If I, let's suppose, have, maybe $50,000 deposited in my bank account, and I write a check to someone for, let's suppose, 55,000. So the bank is going to honor that check because they have an agreement with me to provide an overdraft. Overdraft means some amount of money, some limit which has been provided, which I can use over and above the balance which I actually hold in my bank account. So the limit basically depends company to company based upon their credit worthiness. So this is what bank overdraft is. Now, talking about the advantages over here being that it is flexible, and number two over here that it's an instant source of finance. If I talk about the disadvantages over here, number one is that it is repayable on demand. Anytime the bank can come and ask me to repay the money that I have taken as overdraft. And then second disadvantage, that it is expensive if we use it regularly. Expensive if used regularly. So this is what bank overdraft is. And then let's talk about the second source of short-term finance. This is trade credit. Trade credit is nothing but the credit that your suppliers or anyone who you trade with gives you. So the advantages over here will be, number one, that it is generally cheap. Another thing, that it is flexible. Now let's speak about the disadvantages also. Disadvantages over here being that you may lose on early settlement discounts. Another disadvantage over here being that it may trigger penalties or losing of goodwill if we pay very late. All right. So this was about trade credit. Now we move towards the third source of short-term finance. This is a bill of exchange. Bills of exchange. So you all know what bills of exchange are. What happens over here? That it is your seller of goods who draws a bill towards the buyer. So the buyer who owes the money to the seller. Now this buyer, once he receives the bill, he's going to sign and he's going to return the bill to the seller. Now, the seller has two options. Either he can discount the bill with the bank and get the money instantly, or he can hold it till maturity and then collect the cash from the buyer. So these are the options the seller has once the buyer has accepted and returned the bill of exchange. Usually this used to be there in international transactions, but now it has been replaced. It has been replaced with what? Bank wires, credit or debit cards. So this is what this has been replaced with. Now we will move to the next source of short-term finance, which is a commercial paper. So it's nothing. We have studied this before in chapter 2 also. It's a short-term unsecured debt which is issued by high quality companies. So companies which have good credit ratings are only allowed to issue commercial papers. So if you talk about the advantages over here are number one, that large sums of money can be raised cheaply. Another advantage is that there is no security required. And then the disadvantage over here being that it is only available to large companies with good credit rating. All right. Now moving towards the very last short-term source of finance that we will talk about. This is a short-term bank loan. What will be the duration of these short-term bank loans? Anywhere between 3 months to 1 year. So this is what the duration is going to look like. If we speak about the advantages, number one, that this is available to most companies. Second advantage is that it is typically unsecured, so you do not need an asset to give as a collateral if you want to get a short-term bank loan. And then the third over here being that it is usually done with lower interest rates, usually lower interest rates than long-term loans. Why? Because in the short term, it is considered that the companies have a lower credit risk. So if a company is borrowing for short term, the tendency is that it will repay back the money and there will be no default over here. The risk of default is considered to be less. Now let's speak about the disadvantages also. Disadvantages over here being number one, arrangement fees could be high. And number two over here being that there can be a refinancing risk. This is also called as rollover risk. What do we mean by refinancing risk? This means that let's suppose if I had taken a loan for maybe 4 months, but now I want that loan for another 2 months. So there is a risk that the bank may not allow to roll over to continue the finance for a longer period of time. Now we are done with the short term sources of finance as well. We are moving towards the last segment of this chapter, which is regarding SMEs. So, small and medium enterprises, like we did in the previous chapter as well, where we spoke about the sources of equity for them. So, now the sources of debt for them primarily look like trade credit. Number two is factoring and invoice discounting. Another one is leasing. Number four over here is bank finance, usually overdraft or long-term loans. Long-term loans they will get if they secure it on major assets. Now, if you speak about the government sources through which the SMEs can take finance, number one could be grants and subsidies, and number two could be government loan guarantee scheme. So what will government do over here? The SME will go to a bank that I want a loan, and the government will act as a guarantor that if this SME defaults, I am going to repay the money. So these are the government sources. Now there is also a possibility that they get some finance through business angels. With business angels, they can either go for convertible debt. Again, they will have an option to get equity at the end, or debt with warrants. Again, the right but not the obligation to purchase the shares of the company. So this is how business angels may work in favor of SMEs. Then talking about the second last aspect, which is supply chain financing. Supply chain financing is nothing but, let's suppose this person over here, this is company A, this has bought goods from company B, which is an SME. So company A buys goods from company B, who is an SME. So company B, who has sold the goods, will send an invoice to company A, right? So when the invoice is sent, let's suppose what will happen over here, A can either, so basically this B, the SME, can request the funds from the bank at any time during a period of 30 days, and there will be a small discount for the risk. So bank also needs to take into fact that there is a risk that company A will pay or not. So bank will give a small discount over here. Let's suppose the invoice was for $1,000, so the bank will give probably 995 over here. So this is what a small discount could be like. And then if A delays the payment, then bank has two options. Either the bank can charge interest, or if A defaults, what will the bank do? The bank will suffer bad debt. So if you see, through supply chain financing, this company, the SME, has gotten safe. They got their money. Now, if A delays, bank will deal with it. Even if A defaults, bank will deal with it. So the SME basically got their money. Then let's talk about the very last aspect. This is called P2P lending, peer-to-peer lending. What happens over here is that a lot of small SMEs come together, pool all of their resources in one bank account. One account does not necessarily have to be a bank account. So they pool their resources. Any extra cash that they have is put together in one place, and if any of them, let's suppose this person wants the money, so the money that they have jotted down by pooling, they lend this money to this person at a lower interest rate than the market rate. So what are the advantages over here? Number one advantage, so if if you see from the perspective of the lenders, they get an income, and this exceeds the rate that they will ideally get on bank deposits. So they get an income which is more than the bank deposits. Secondly, talking from the perspective of borrowers have the access to finance when the banks are not giving them credit. So when banks refuse credit or charge high interest rates. And the third benefit over here is that the middlemen gets get eliminated. So who's the middleman? Usually, if you're taking a loan, there will be one person who is borrowing, one person who's lending, and there's going to be one intermediary, one mediator who's going to connect both of these parties together. So when it comes to P2P lending, basically the middleman, the bank, gets eliminated. So the interest rates are more attractive for both borrowers as well as lenders. So the third advantage that you can write, that interest rates are attractive for borrowers and lenders. So with this, we are done with chapter number 8. This was about the cost of debt. Different sources of debt have been discussed over here. In the next chapter, we are going to talk about the weighted average cost of capital. So stay tuned for that. I hope that this was useful. Thank you so much for watching.